With a DSCR loan, there's 7 major factors that lenders use to be able to qualify you for the rate that they're offering. First, we have the loan to value. So that's the property value or appraised value versus the loan amount. So if you have a property that's valued at $200,000 and you have a loan that's $150,000, that would be considered 75% loan to value. As you get closer to 100%, obviously the risk is higher to the bank, so that comes with a higher rate. Most lenders will loan up to 80% on a purchase, some up to 85% if you have a 720 credit score or higher. It's really going to depend on your credit score, what the minimum down payment will be. The second major factor that lenders look at is your credit score. Now, I have some lenders that will go all the way down to 600 credit score, but they're going to require a much larger down payment, like 35%. And then most lenders want a credit score of 680 or higher to be able to do as little as 20% down on a DSCR loan. The third major factor that lenders look at for the rate that you qualify for is the loan purpose. Is it a purchase or a refinance? And then if it's a refinance, are you just refinancing the current loan balance of your mortgage, so rate and term refinance? Or are you looking to pull cash out of the property? If you're looking to pull cash out of the property, a lot of the times the rate is slightly higher because that's riskier to the bank. It makes the bank seem like you need money. Okay, so those are some factors that you want to consider, is how much money you want to take out of the property. Just like the first factor, loan to value, that's also going to impact that. So you want to look and balance out how much cash you want on a cash out loan versus the loan to value and the rate that you're actually going to qualify for. The fourth main factor that lenders consider for the rate that you qualify for on a DSCR loan is the property type. Is it a single family residential home? That's the safest investment for them. Or is it a multifamily? If it's a multifamily, is it 2 units, 3 units, or 4 units? Is it a condo or maybe a condotel or a townhouse? All of those different property types come with different rates. So we need to consider that when we're going out there and we're looking at which type of properties we may want to invest into. You want to know ahead of time that they may come with a higher rate depending on what type of property it is. The fifth factor is what you choose for a prepayment penalty when it comes to DSCR loans. The fifth factor is what you choose regarding a prepayment penalty. With DSCR loans, most do have prepayment penalties anywhere from a no prepayment penalty up to 5 years. The longer you choose, obviously, the less risk to the lender, so the better rate in term, but obviously there's some negatives to having a 5-year prepayment penalty on the loan, so you need to consider that. That's why you want to work with somebody that's willing to go through all of the options, meaning here's your rate if you do a no prepayment, here it is if it's 1 year, 2 year, 3 year, 4 year, and 5 year. That way you can run the numbers and make the best decision for you. The sixth factor is if you're a first-time investor or an experienced investor. Now, being an experienced investor, you either own some rentals currently, or if it's fix and flip, that you flipped 3 properties in the past 18 months with most lenders. Now, if you're a first-time investor, we still have a ton of lenders that will work with you. They just typically have a slightly higher rate because it's a little bit riskier since you've never done it before. And the largest factor lenders use to determine the rate that you're going to qualify for is the DSCR ratio itself. What is the rents or projected rents compared to the housing payment, which is principal, interest, property taxes, insurance, and any association dues? Are they 1-to-1 or 1 to 1.15? That's usually like a bucket that most lenders use. If so, that's like the minimum standard. That's going to come with a higher rate than if the rents coming in would be like 1.5 what the housing payment is. Now, you might actually want to purchase a property that doesn't ratio out because you believe that with short-term rents that it will bring in more money, or you're fine with going slightly negative because you want to get into that housing market because you see homes appreciating over the next couple of years. That's called either a no ratio loan, or some lenders go from 0.75 to 1. All of these factors are what lenders are going to consider to see what rate you qualify for. Now, you're not qualifying for just one rate. Okay, it's just called a par rate, and that rate is the rate that lenders offer you with you not having to pay discount points. Then from there, there's an entire rate sheet that goes up and down. If you want to buy the rate down, you can. It's just going to be called discount points. And with that, it's basically paying prepaid interest. So you really need to do the calculation of the 2 different housing payments. Principal interest on this one, let's say is $1,000. Principal interest on this one is $950. So you're saving $50 a month. Let's just say that it's $2,000 to buy the rate down. You would divide 2,000 by 50. We're talking 40 months. Okay, so a little over 3 years. If you feel like you're going to sell that property or refinance before that 40 months is over, you're not really benefiting from buying that rate down. That's why it's key to work with a mortgage broker who will walk through all of these numbers with you, present you with all the options, and then at that point, you can make the best decision for you, your property, and what your investment goals are. If you have any scenarios that you want to run or you have additional questions, just DM me. We'll hop on the phone. We'll run through all of your questions and then the loan options that you can qualify for. And then from there, you can make the best decision if it's a loan that you want to move forward with or a property that you want to invest in.